You're listening to the Doc Lounge podcast. This is a place for candid healthcare conversations with physician recruitment industry's top executives and thought leaders. This podcast is made possible by Pacific Companies, your trusted advisor in physician recruitment.
Well, good morning. This is John Paulk with Pacific Companies, and we're here to do a podcast this morning, and we have a couple of guests in the studio. I've got Mike Genovese of Grant Genovese and Baratta, and Chris Lekawa, also a partner in Grant Genovese and Baratta. And we're here to talk about, broadly defined as succession planning, or in layman's terms, when an existing practice wants to bring on an associate that may wish to acquire a portion of the practice or the entire practice itself. And so this the legal aspect of this exceeds my capacity. That's why we've got two experts in here who have quite a bit of experience in this. Grant Genovese and Baratta is a California firm located in Irvine, California, and these gentlemen, among their other colleagues, specialize in contract law, mergers and acquisitions, and business transactions. So we've had the opportunity to work with them as well. But we were talking earlier, and you guys have quite a bit of experience dealing with this very thing. Is that correct?
Yes. In fact, my experience started many, many years ago. I get to date myself here. In 1970, I went to work for a public accounting firm, Ernst & Ernst, now Ernst & Young, and did a lot of the tax work for doctors and medical groups. And that gravitated into my law practice and starting in 1976. And as you can imagine, around that time in Orange County, real estate was booming, so a lot of clients were doing a lot of real estate work and 1031 exchanges. But my practice also allowed me to take some of the doctor clients that I had and move forward with helping them form medical practices, partnerships, orthopedic groups, things like that. And over the years, we get referrals and doctors calling us who decide they want to sell their practice, they want to employ another doctor or set up some kind of a partnership group. And so we've dealt with that also. I'm obviously conversant in the tax issues, but we always still today bring in a tax CPA to guide us along. It used to be I could go next door and talk to my fellow CPA and talk tax. Since I can't do that now, I make sure we bring in outside CPA counsel to advise.
Excellent. And Chris, you've got a few years of experience at this as well, is that right?
That's correct. I joined the firm in 2012 and started with Mike then, and have developed the practice further. And we've worked with a lot of healthcare professionals and through their succession planning and have moved forward together.
Well, yeah, I described earlier to you a little bit of the kind of the typical scenario that we get. We're retained on behalf of a private practice. It's a solo practitioner who's set up either as an S Corp or a C Corp and has decided at some point in the not too distant future would like to transition out of the practice. They may have also had other reasons for adding a colleague because the volume, patient volume has picked up, and they are looking at meeting that ongoing demand. And so what are the first couple of documents that a physician who's looking to add that associate should be considering? Or what are some of the first steps that they should take in preparation for this?
Generally, what we like to do in working with these physicians is setting things up on kind of a pre-planning approach, which is going to include corporate cleanup. A doctor or a healthcare facility that is looking to bring on an associate with the idea of succession planning needs to first look internally. They need to look at their long-term contracts. They need to look at their corporate governance, their books and records, and they need to make sure that everything is ready to go for this next phase. But when they've done that, the next phase is then to help kind of prospect. And they're going to try and find the talent that they're wanting to bring in. And once they've done that, then it's a matter of kind of outlining the next phases of what bringing that physician in looks like. And as a part of that, when they have found that physician, oftentimes they'll enter into dialogue and then they'll come to us and speak about what their timeframes are. And as a part of the timeframes, they're going to be lining out a due diligence investigation period, but at the same time entering into this kind of transition phase where the physician may come on board either as an employee or as an independent contractor, depending on various scenarios. But then they'll come on board and then look towards transitioning some of these patients moving forward together. Those are some of those initial phases, unless Mike has some other.
Yeah, so I think
comments.
you kind of break it down into a couple of different areas. I mean, one area is the physician wants to sell his practice, and he wants to get set up as best he can to do that. Chris is right. A lot of times the doctors' corporations need to be cleaned up from the standpoint of just making sure that their entity is in good standing with the proper minutes and resolutions and election of officers and directors and things like that. Some real basic stuff just to make sure that that part's ready to go. And then you look at this as either I'm going to enter into some kind of a buy-sell agreement, purchase agreement, where I'm going to sell the practice and determine if you're going to do that, do you need to bring somebody in initially to see if they're a good fit for your patients? Do you need to bring somebody in under an employment arrangement or an independent contractor arrangement? Or the doctor may say, you know, my practice, I'm going to be here for a little while. I'm not going to just simply sell and be gone right away, even if I transition a little bit for a year in a sale transaction. He may say, I want to bring somebody in who can get to know my patients, understand my methodology of practice. I get comfortable with their patient care approach, and so you bring that doctor in and maybe form a partnership group. Each doctor would have his own entity, generally speaking, in that arrangement. Each doctor would be incorporated. Most likely, they would be subchapter S corporations from a tax standpoint, but there are doctors who have C corporations, which is just simply a corporation that is its own tax-paying entity. But the other doctor could maybe form his own corporation. Those two corporations would then be the partners in a partnership. And the partnership document is what really dictates how they're going to share in the patient load, the revenue, the costs and expenses, the overhead. Maybe one of the goals is the doctor who's going to transition out at some point in time simply wants to start helping, having somebody help share in his administrative costs and overhead, and while he's getting to know his practice. And that partnership agreement can also have a buy-sell arrangement in it. It all depends on what the doctors are trying to achieve, what their goals are, and that's really what needs to be tailored. There is no one-size-fits-all, generally speaking. The one-size-fits-all concept is where a doctor just wants to sell. He goes out and finds a doctor that wants to buy, and you set up a purchase and sale agreement and a transition agreement and work through all of those aspects. That's more of a one-size-fits-all. Anything beyond that is tailored to what the doctors are trying to achieve.
Okay. We're frequently brought in at an early stage in the process for the purposes of hiring, finding that individual who wants to participate in a growing entity. Maybe they're going to be the second or the third physician in that group. We're going to do our due diligence to understand what that practice looks like and represent that to that candidate, introduce them, of course, to the existing physician in that practice. But where we often reach our capacity is what do they need to do from a legal point of view. And so you've touched on a number of those items, both Chris and Mike. The question that I sometimes have is, should they be looking at determining a valuation early in the process? We generally have been asked to bring in physicians as an employee with the idea that over the next year or year and a half to 2 years, the existing physician has the opportunity to work with this individual, but typically there's a request or an expectation that ownership interest will then become available to me. And so walk us through the simple process of how I, as a new physician, would go in and become a potential shareholder, therefore participating in profit distributions in that entity. Is there a simple way of explaining that?
Well, take a practice. Take a practice where a doctor has, a plastic surgery practice, and in that plastic surgery practice, he's got all kinds of different aspects to it. He's got the Mohs surgery aspect. He's got a whole different. You can imagine all the plastic surgery doctors now have all kinds of different things that they promote and that they believe in, and that they build up a clientele on that basis. And those practices generally have a following of patients for a long time. I mean, they develop a larger and larger and larger following. They may bring a doctor in under generally an employment arrangement or an independent contractor arrangement, depending on how the relationship's going to be, to get his feet wet in that practice. And that doctor's maybe going to also develop a following in that practice. So up front, they may want to have some understanding as to how the new doctor could come into that practice and get some ownership. And a lot of that has to do obviously with the economics and the valuation. And when you've got a so-called, I'll call it a book of business, for lack of a better word, in the medical practice, they probably call it something else, a book of patients maybe, but it has an income stream. And yes, they should try to get some general idea of valuation of that practice. There's a lot of different companies out there that help in those valuation processes. It may be as simple as simply understanding the EBITDA formula for earnings before interest, taxes, depreciation, amortization. But it's also somebody who's familiar with medical practices, so they know how long patients' longevity is, generally speaking, and sticks with the practice. And there may be some attrition that's typical when you have another doctor coming in, another doctor is moving out. There's valuation people that take a lot of that in consideration. So valuation is important, and then figuring out how to structure bringing the new doctor in so that it's not a burden from a tax standpoint is important. If the doctor has a medical practice and it's a corporation and he wants to bring a doctor in to help transition him going out, if he sells, that's a tax consequence. The doctor coming in wants to know, when I buy, am I getting any benefits from the acquisition price to allocate to items that I can write off to help ease the pain of buying in. The doctor selling is going to want to know, how much can I get for capital gains, how much can I as ordinary income. There's all these tax consequences. If you form a partnership and you bring somebody in who's also bringing in clients from time to time, you may be able to bring that doctor into a partnership group where he gets a profits interest and not a interest in the existing capital ownership of the company. It's more of a profits interest of the going forward business. So he can get some, he doesn't necessarily have a tax consequence if that partnership interest he's getting is not considered something of value at that time. So there's lots of different things to consider. And back to your original question, yes, definitely you should get some ideas, the valuation of your practice, if that is because that's important. But if it's more important to say, I need my patients to be taken care of properly, and I really don't have the ability to nail down a strong valuation, we'll call it goodwill, because you may be in practice for so long, your equipment may be fully depreciated, it may be somewhat antiquated, the new doctor is going to want to replace a lot of it anyway. There may or may not be any value in your lease. You may be able to lease the same space at relatively the same rental rate, so there may not be any upside value in that. So you need to know where your values are and what your goals are as far as trying to transition yourself out, as to whether or not there's anything you can sell in the form of goodwill, which would be a good capital gain value for the doctor buying in, or for the doctor selling, and the doctor buying in gets a 15-year amortization write-off for the purchase of goodwill. So there's some give and take there.
Well, we're frequently frustrated with. We're able to find interested candidates considering this, but the physician who's the recipient of the new recruit hasn't taken these steps to prepare the environment to be conducive to bringing that person in. And so it seems perhaps a bit more complicated than I had originally estimated, a lot of considerations there. Chris, you've had some recent experience. How does that differ from some of the options that Mike has discussed?
Sure. Mike touched on a lot of great things concerning valuation and having proper entity formation in place in order to bring on an employee. But in the scenario where we have a physician that is thinking about retiring or moving on, a lot of times you're not seeing proper planning going into place. And so you're seeing a little bit of a last minute kind of a quick plan, something that gets planned over maybe in the next 12 months. And so in that scenario, that's kind of going back to my initial plan on bringing in that new physician. Bringing in that new physician can take the form of many different avenues with regard to the agreements. And so the agreement, as we mentioned initially, can be brought in with either an employment agreement or an independent contractor agreement, with at the same time a letter of intent or even possibly a purchase and sale agreement at the outset. But it's a delayed closing transaction of being able to acquire the practice. So essentially you'll have an opening of escrow, if you will. Not necessarily an escrow, but you'll have an opening of an agreement. And then they'll go ahead and go through this transition period where the new physician is coming on board as either an independent contractor or as an employee, getting introduced, and then at the same time going through this transition period where they are being introduced to all of the new patients. They're becoming more and more familiar with the insurance carriers, with the referral sources, with their staff, understanding the equipment in place. Maybe there's a lease or real estate owned issues that they need to deal with. But in the scenario, again, going back to where there's a short time frame, the retiring physician may not have developed this full and complete succession plan. So in that scenario, you kind of dive right in and you look for a 12-month period, 12, 18, 24-month period where this new physician is coming on board and going through this employment agreement while at the same time they're going through a transition or a closing, and where they will ultimately end up acquiring the new practice. I hope that answers your question.
Yeah. If you were to extend that scenario, let's say, for instance, in this not entirely hypothetical scenario we've discussed, that new physician stepping in there, let's say they came back to Grant, Genovese, and Baratta and said, hey, I'm looking to add a colleague now. Based on that structure, what would the steps, what steps would be required to proceed from there?
So in the two buckets we're kind of talking about are, one is selling a practice and the other is bringing somebody in that might ultimately participate in the acquisition and succession planning of the practice. In the latter that you're kind of talking about, I think the concept there would be to talk to the doctor to make sure he has some valuation idea of his practice, where his practice is cash flow wise, where his overhead is, to really get some idea of the valuation of that practice. And then you'd talk about putting together possibly a partnership agreement, actually an agreement bringing in another doctor to help partner up and decide how you share in what that practice is going to produce. Because this other doctor is he's going to work, he's going to provide services, and you could do it with employment, you could do it with independent contractor, or you could bring that doctor in as a partner. Generally speaking, I think it's always prudent to have some idea who you're working with first. I mean, this isn't unlike any other type of service-related business. A law firm take it. Associates come in and they work, and the people get to know them, and the partners decide, we're going to make him a partner. And how are we going to bring that individual in as a partner? In the medical practice, it would be the same thing. If you can bring them in initially to get to understand what their capabilities are and how they fit into the type of practice that you've had over the years, that's a great opportunity. So this succession planning, as opposed to just, I'm going to sell the practice, like Chris said, is real important from the standpoint of the pre-planning part of ultimately selling the practice. Bringing somebody in either as an employee, independent contractor, or a partnership agreement, or some kind of agreement that gives the new doctor coming in the incentive and the understanding that he's going to be adequately compensated for what he's doing now, that he's interested in this practice, otherwise he wouldn't be coming in initially, and what he can look forward to possibly in acquiring. You could at that point set up the parameters for what he could buy that practice for. You could set that up in an agreement that would accomplish what both doctors are trying to accomplish if that other doctor's main goal is to definitely have succession planning. And the one thing to not lose sight of is in any plan like that, when the new doctor comes in and acquires the practice or takes control, a majority interest in the practice, having the doctor who's phasing out stay on for a period of time with the transition understanding is important.
We frequently see at least 18 months is sort of the stated benchmark for that. The theory being that each of the patients that existed in the practice prior to the arrival of the new physician will have been seen during that period of time. Chris, you wanted to add something?
Just that Mike was making mention to forming a partnership or whatnot, and the entity can be that of a corporation as well. And the same thing would apply. Whether you're going to have a shareholder agreement or potentially a buy-sell agreement between the new physician, those benchmarks can also be dovetailed into an employment agreement. And if in the planning phase, the current physician, just like you said, wanted to bring on a colleague, and he understands that, okay, well, if the colleague comes in and if he hasn't, if he's performing, if he is bringing new business to the table, if he is doing certain parameters, that might then give him the right to buy into certain portions of the company. So that can be structured, but again, that all goes back to planning, and every scenario is a little bit different. So if you have a physician group that wants to bring in more physicians and entice them with ownership opportunities, understanding what those parameters are going to be is crucial, because those can be outlined in your documents. And whether it's a partnership or whether it is a corporation, and they're going to be and the new physician is going to be acquiring partnership interest or shares, will be triggered based upon those parameters. And having a clear understanding of that is truly the best practice.
What we fret about when we go in and profile the practice initially, we frequently will delve into, at least at a cursory level, the financials and get an understanding of what the plan is for bringing in somebody else. In many instances, the physician, as we've discussed, is close to contemplating retirement, maybe gradually fading into the sunset. In other instances, the practice is thriving, and we're looking at adding staff to meet the growing demand, as well as the ancillary benefit of reducing the fixed costs by distributing it equally over an additional provider. Sometimes the challenge is we're bringing in somebody who's expecting to be remunerated. And so I don't know if this would prohibit us from offering an employment agreement, but you said it could be dovetailed into a partnership, which would lend itself to the next steps into becoming a shareholder. Is that correct?
Well, a partnership structure is relatively flexible structure. Corporation has a little bit more rigidity to it, especially from a tax standpoint. So a lot of times you look at these groups and they're partnership groups, and the partners in those partnership groups are individual doctors who have incorporated themselves as professional corporations, so that they have certain limited liability protections. They still have their malpractice insurance protection and all of that, because that's something that you can't really shield. But they still have limited liability protections from just the nature of the business of the medical practice. I mean, you're buying a lot of expensive equipment these days. You're signing leases. You know, if you don't have to have personal guarantees out there, if you can have some limited liability protection, you want to look at all that. But the partnership, or an agreement like a partnership that deals with the sharing of costs and the allocation of sharing of revenues, compensation, that's something that you deal with in understanding what the doctor's trying to achieve, that's wants to bring somebody in, and what he's willing to remunerate the new doctor. I don't know if that comes across really well verbally, but compensate the other doctor. Doctors don't want to work for free. They did that in their residency program, right? I mean, my son's a general surgery resident, and I've been through that program with him, and he's now about to become a fellow. He'll get about the same less than minimum wage fee when he's doing that. So they want to be compensated when they're ready to get out into the practice.
We've got jobs for him, Mike.
You'll be the first person I'll be calling, yeah.
Okay.
It'll help me a lot. So but yeah, they do want to be compensated. But that's the whole idea of a doctor bringing somebody in, is that doctor's going to work. He's going to provide a service. There's going to be revenue generated from that. So you ought to be able to develop a pro forma and a model that shows what that is, and allow that doctor to receive a base draw from the practice. And then the question is what can he earn in excess of that base draw? That's more like the sharing of the success of the practice group itself. And then you get to the point, what can he buy the practice for? Is there a formula base that he can look to in the future to buy that practice and own that practice for the doctor that eventually wants to move out? These are all elements that you kind of need to look at, and you just have to start at the beginning. What is the doctor who's in whatever stage he's in trying to accomplish? Is it to bring somebody in and grow the practice and ultimately sell? Is it to sell right now? Is he willing to transition for a while in that sale transaction? You need to really understand the goals of each party in order to help them do what they need to do. But one of the things that I think that you're trying to accomplish, at least initially for the benefit of the doctors out there, is to make sure, what do they need to do first? And the first thing they need to do is make sure they've got their practice structure and entity documents in order. That's the first thing they need to make sure. And let's assume they're already cleaned up, they've already got that going. Then the next concept is to get some idea as to valuation of that practice. Is that practice have a goodwill value over and above the asset value? Is that doctor got a book of receivables? Are the receivables going to go with the sale? Is it going to be does he want to consider a stock sale if he's a corporation, or an asset sale? Even if he's a corporation, an asset sale transaction. The tax consequences associated with that. These are all steps that he probably should get familiar with, and probably in advance of going out and finding that perfect person that he wants to participate with in a succession plan. Another doctor who he wants to take over his practice, or come in and partner up with in his practice, or otherwise.
All right, well, we're out of time for today, but clearly there's a lot more we can discuss here, and I appreciate both Mike and Chris for coming in today. Again, it's Mike and Chris from Grant, Genovese, and Baratta. And if we want to direct somebody to you guys with your deep expertise, how should they reach out to you?
Certainly, they can visit us online at www.ggbgenovese.com. pacific-law.com, or they can give us a call anytime, 949-660-1600.
That's easy to remember. All right. Well, thanks again for coming in today. We look forward to seeing you guys here in the next session.
Yeah, thank you, John. This is, the topic can morph into so many different areas and different nuances with regard to any transaction. It's like anything else. It's what does the one party want to accomplish? What does the other party want to accomplish? I mean, you even get into the buying partner, the buying doctor coming in saying, how can I afford it? How can I buy in? Who should I reach out to? Will a bank finance this? Do I have to give a personal guarantee? And what are the economics of that? What's the cash flow benefit to me that will allow me to pay off that acquisition price? And at the end of the day, I'm 100% owner, and now I get to reap the benefits of the entire practice. There's all kinds of financial considerations, obviously, clearly in this, aside from the most important part of patient care and what the doctor really wants to accomplish to make sure that the doctor that he's associating himself with is going to continue to take care of his practice the way he did. All that is, I think, of utmost importance. But then again, us lawyers and tax accountants and everybody else has to get involved in the transaction.
Absolutely. Well, I'm going to look forward to seeing you guys here in a few days, and we'll pick up where we left off.
Okay, thanks,
Sounds
John.
great.
Thanks,
you.
guys.
Appreciate it.
Thank you to all our listeners. If you'd like to be notified when new episodes air, make sure to hit that subscribe button. And thank you to Pacific Companies. Without you guys, this podcast would not be possible. If you'd like to be a guest or for more information, go to www.pacificcompanies.com.